Hey everybody, today is Wednesday, the 20th of September, and the Fed met, and we were right for being cautious because the market got annihilated here after that meeting. Of course, we ran up to the anchored volume weighted average price from the August low, and that has been resistance here the last week and a half, and we came up to the anchored volume weighted average price from last week's high. So those two areas, plus the declining 5-day moving average, is what kept us on guard. It now looks like the market is headed for a test of the anchored volume weighted average price from the late April low. We bounced pretty perfectly from there last time we were at that level, and now it looks like we're headed there again, perhaps down towards that 435-ish level. That's really about 435.20, but we tend to overshoot those levels when we come down through them, and we now have a declining 50-day moving average. That's that blue line right there. You can see that yesterday it was 447.51. Today it's 447.43. That will continue to decline as we get rid of this data. So over the next 3 weeks, really, unless this market can turn itself around and replace these levels with higher prices, that 50-day moving average is going to be declining like this. Well, guess what? The 20-day moving average just starting to flatten out. Tomorrow we'll get rid of this data. And on Friday, we get rid of this data. Next Monday, we'll really start to see that 20-day moving average curl over as well. So this market in the intermediate term remains guilty until proven innocent. A lot of people yesterday were questioning me saying, well, what about this rally? What about this big rally? And I said, listen, we're still below declining 5-day moving average. It's okay for a day trade, but anything beyond that is highly suspect. We still have a pattern of lower highs and lower lows. And we got an exclamation point on that lower low here today. For the NASDAQ, we saw the same thing. We saw that anchored volume weighted average price from the August low. Not quite perfect resistance, but still it was a problem. From last week's high, we saw that act as resistance almost perfectly. And of course, we have the declining 5-day moving average, which, as you know, I will repeat it till I'm in my grave. Anything below a declining 5-day moving average should be considered a bounce within an intermediate term downtrend. If you want to day trade it, that's fine. But it looks now like the sellers have regained the momentum, and I'm looking for the market to come down to this level here in the near term. What's the near term? Probably in the next week and a half or so, 358. But I mean, this could happen tomorrow if we get enough fear in the market. So any rally attempt in here, if you want to day trade it based on a 1-minute chart using the volume weighted average price for the day, that's fine. But beyond that, I would consider rallies as guilty till proven innocent, more likely to fail than to follow through on the upside. The Russell 2000 hit a new low for this recent move, not for the year, of course, but when we go back to the longer term time frame, you can see it's now down not only through the year-to-date anchored volume weighted average price, that's that purple line that it had been dancing on, but also below the anchored volume weighted average price from the 2022 low. So this market just looks like garbage. As I've pointed out with this head and shoulders pattern, it looks a little too obvious. But if it is going to play out, then what we do is we take the height of the pattern, 182, up to, let's just call it 197. That's 15 points. And we subtract that 15 points from the breakdown point of 183. So 183 minus 15 is what, 172 or so? It looks ugly. I wouldn't be looking to be a buyer in this market. It's been broadcasting that message for a while. It's guilty till proven innocent. The Russell 2000 is just trash for your money. Semiconductors, this was the group we were most concerned about coming into this week. We have broken, obviously, that support previously and below this level. Now we're back below this level, which a lot of times what we see is a quick flush below a prior extreme low like that and then a bounce. So maybe it comes down to the anchored volume weighted average price from this point right here, and that is the May low. That's what we're looking at next. Oh, I'm sorry, the red one is from this high. So maybe it comes down and through that purple one, and then we get a little bounce. But I'm looking for something like this to happen. It just looks like, as we've pointed out before, a double-headed head and shoulders top. And if we were to use that same measuring technique for a potential downside objective, we would go straight up from 144 to 160 and that is 16 points. Subtract that from 145. That gives you a price target down near 129. I'm not sure that is likely to happen. It's more likely, I think, that we would find some buyers from the anchored volume weighted average price from the beginning of the year. And by the time we get there, that's where that 200-day moving average will be as well. So it could look like something like that over the next coming weeks. But, semiconductors, don't look at them as a bargain. Look at them as guilty till proven innocent while they're below declining 5-day moving average. There's just no reason to be a buyer in there. And now, again, we have the declining 20 and 50-day moving average. That's that red. That's the 20. That 50 is the blue. They're both declining. That's not a good environment for being a buyer. Biotechs continue to do what they've been doing best since mid-June high. That is carve out this beautiful pattern of lower highs and lower lows. Maybe it gets a bounce in here somewhere, but if it does, I would expect it to continue to do this. It's in a downtrend. A trend once established is more likely to continue than reverse. If you look at the weekly time frame, we're down at the bottom end of what has been the recent range, and there's no guarantee that that's going to hold up. There's nothing to say we can't come down and make a new low from that 2022 low. So they're guilty till proven innocent. They're not a bargain. The financials, you look at this weekly chart, they're really holding up better. There's the anchor from the recent high. Let's look at that on our 2 time frames. And again, that's the daily on the left and the 30-minute on the right. This is what I pointed out to subscribers yesterday. These guys are basically a waste of time, that they were right to the midpoint of this recent range, and now we're right to the bottom point of that. I think that they're a waste of time. I don't trade financials anyway, so I really don't feel like talking about them. Energy names came down to the anchored volume weighted average price from what was the August low for the broader markets, but for this market, what did we do? We came up to this prior band of resistance, which we had spoken about a lot the last week and a half. They failed there. Now they're coming down to this prior band of resistance. Resistance, once broken, tends to act as support. It's also at the 20-day moving average. We want to put an anchored volume weighted average price off of this low, which is right here. And you can see we've exceeded that. So this is why we don't buy at anchored VWAPs. We look at them and say, here's a level of interest that I want to look to a shorter term time frame and see if there's evidence the buyers are gaining control. So if we look at a 5-minute time frame, for instance, there is zero evidence. There's no reason to be a buyer.